friends, welcome back to our channel, Grow Your Wealth. Here is your friend K. Anand. Confused about the old and new tax regimes in India? You're not alone. It's a common predicament, with many finding themselves caught in a whirl of tax slabs, deductions, and exemptions. This video is your guide to understanding these two tax systems. If you have not subscribed to the channel, please hit the bell icon so that you can get the notifications. Also, like the video to value the such rich content. Chapter 1, Income Tax. Slabs. What is an income tax slab? In India, the income tax applies to individuals based on a slab system, where different tax rates are assigned to different income ranges. As the person's income increases, the tax rates also increase. This type of taxation allows for a fair and progressive tax system in the country. The income tax slabs are revised periodically, typically during each budget. These slab rates vary for different groups of taxpayers. The old tax regime, it's familiar and has been around for years. Yes, you heard it right. The old tax regime in India has been a constant companion for taxpayers over the years. But why do we stick to it? Let's delve into the advantages that make it a viable choice. First and foremost, familiarity. The old tax regime follows the traditional tax structure that taxpayers are accustomed to. It's like an old friend, isn't it? We know its quirks, its charm, and most importantly, how to navigate it. This familiarity often provides a sense of comfort to those who are not ready to jump into the unknown. Next up, tax-saving investments. The old tax regime allows for a plethora of tax-saving investments. These include the Public Provident Fund, Equity-Linked Savings Scheme, and National Pension System, among others. It's like a buffet of options, isn't it? You can pick and choose what suits your financial goals best. And then we have the exemptions. House rent allowance and leave travel allowance can be exempt under certain conditions, providing additional tax savings. It's like getting a discount on your tax bill, isn't it? Who doesn't love a good deal? Perhaps one of the most significant perks of the old tax regime lies in its deductions. Taxpayers can claim deductions under Section 80C for investments in instruments like the Employee Provident Fund, life insurance premiums, and tuition fees. Think of it as a reward for being financially responsible. The more you invest, the more you save on taxes. But it's not all rosy with the old regime. As we switch gears to discuss the disadvantages, keep in mind that no system is perfect. It's all about finding the balance that works best for your individual financial situation. After all, when it comes to taxes, one size definitely does not fit all. While the old tax regime has its perks, it also comes with a fair share of drawbacks. Let's delve into these disadvantages, shall we? First on our list is complexity. The old tax regime, steeped in tradition, comes with a plethora of deductions and exemptions. While this could be a good thing for those who know how to navigate the labyrinth, for many, it can make tax calculations quite complicated. Often, the complexity of the process requires professional assistance, which can lead to additional costs. Next up, we have a limited scope for optimization. Sure, the old tax regime provides various avenues for tax-saving investments, such as Public Provident Fund, Equity-Linked Savings Scheme, and National Pension System, among others. But taxpayers may miss out on potential tax savings if they are not aware of all available deductions. It's a bit like having a treasure map but not knowing how to read it. Lastly, we have potentially higher tax liability due to fewer tax saving options. Taxpayers may end up with a higher tax liability. In a nutshell, this means that despite the potential for numerous deductions and exemptions, if not utilized wisely, taxpayers could end up paying more taxes under the old tax regime. These drawbacks, while significant, do not render the old tax regime obsolete. It merely highlights the need for careful consideration and perhaps professional advice. The old tax regime, like a well-aged wine, has its distinctive characteristics that some may prefer. It provides a safety net of familiarity and allows for certain benefits that may be beneficial to individual taxpayers. Nonetheless, the complexity, limited optimization, and the potential for higher tax liability are considerable factors that one must weigh before choosing the old tax regime. These factors underscore the importance of understanding the nuances of the tax regime one opts for. Now that we've covered the old, let's move on to the new tax regime. Like a new chapter in a book, it brings with it a fresh perspective and its own set of challenges and advantages. But that's a tale for another scene. Stay tuned. Enter the new tax regime, a simplified structure with lower tax rates and zero deductions. This new system is designed to make taxes a more streamlined process for taxpayers across the country. One of the most significant advantages of this new tax regime is its simplified structure. Gone are the days of navigating through a labyrinth of deductions and exemptions. Here, the tax rates are lower and there are no deductions to worry about. This brings us to the next advantage: clarity. The absence of deductions and exemptions makes tax calculations straightforward. No more tracking down receipts, calculating percentages, or wondering if you've missed out on any tax saving opportunities. Everything is clear cut, making the process far less daunting than before. Another advantage that comes with this new regime is the reduced compliance burden. This simplified structure means that taxpayers don't need to spend time and effort gathering documents for deductions. It's a considerable relief, isn't it? Imagine not having to rummage through files or old emails, hunting for proof of expenses or investments. The new tax regime takes that burden off your shoulders, making compliance easier than it's ever been. Lastly, the new tax regime offers flexibility. Every year, taxpayers can choose between the old and new tax regimes based on their individual financial situations. This choice allows taxpayers to evaluate their financial scenario each year and make the choice that best suits them. It's like having an annual tax strategy session with yourself. In a nutshell, the new tax regime simplifies the tax structure, brings clarity to tax calculations, reduces the compliance burden, and offers yearly flexibility. These advantages make it an attractive option for many, but like all things, it's not a one-size-fits-all solution. However, the new regime also has its downfalls, but that's a discussion for the next scene. Alright? While the new tax regime simplifies things, it does come with its own set of disadvantages. It's crucial to remember that every coin has two sides, and the new tax regime in India is no exception. While its simplified structure and lower tax rates may seem appealing, it's also important to consider the potential drawbacks. One of the most significant disadvantages is the loss of deductions. Under the new tax regime, taxpayers lose out on the various deductions that were available under the old system. This includes the deductions under Section ATC, ATD, and others. These deductions, which included things like employee provident fund, life insurance premiums, and tuition fees, provided a way for taxpayers to reduce their taxable income. Under the new regime, these options are no longer available. This brings us to the second disadvantage: limited tax savings. Without the availability of these deductions, taxpayers may find themselves with fewer avenues to reduce their taxable income. This could potentially lead to a higher tax liability, despite the lower tax rates. Finally, the new tax regime could have a significant impact on specific categories of taxpayers. For instance, those with home loans or high medical expenses, who could previously claim substantial deductions, may find the new regime less beneficial. The loss of these deductions could result in a higher tax burden, offsetting the benefits of the lower tax rates. It's also worth noting that while the new regime does offer a simplified structure, this simplicity comes at a cost: the loss of deductions and exemptions, and the potential for higher tax liability for certain categories of taxpayers are important factors to consider when evaluating the new tax regime. In conclusion, while the new tax regime offers a simplified approach and lower tax rates, it also comes with its own set of disadvantages. It's important for taxpayers to carefully consider these drawbacks when deciding between the old and new tax regimes. With both the old and new regimes laid out, let's do a quick comparison. Now that we've examined both tax regimes, let's summarize the key points. The old tax regime, with its familiar structure, is peppered with potential tax-saving opportunities. It allows for deductions and exemptions on investments, house rent allowance, and leave travel allowance. However, its complexity can be daunting, and it may lead to a higher tax liability due to limited optimization. On the other hand, the new tax regime brings simplicity and clarity to the table. It offers lower tax rates with zero deductions, easing the compliance burden. However, it does take away the opportunity to claim deductions, which could limit tax savings, especially for those with substantial deductions like home loans or high medical expenses. Old tax regime versus new tax regime, which is better? The new tax regime can largely benefit middle-class taxpayers who have a taxable income of up to Rs 15 lakh. The old regime is a better option for high-income earners. The new income tax regime is beneficial for people who make low investments. As the new regime offers 6 lower income tax slabs, anyone paying taxes without claiming tax deductions can benefit from paying a lower rate of tax under the new tax regime. For instance, the assessee having total income before deduction up to Rs 12 lakh will have higher tax liability under the old system if they have investments less than Rs 3,12,500. Therefore, if you invest less in tax saving schemes, go for the new regime. That being said, if you already have in place a financial plan for wealth creation by making investments in tax saving instruments, medical claims, and life insurance, making payments of children's tuition fees, payment of EMIs on education loan, buying a house with a home loan, and so on, the old regime helps you with higher tax deductions and lower tax outgo. In light of the above, and considering the new income tax regime, if taxpayers want to opt for the concessional tax rates, they may evaluate both regimes. Hence, it is advisable to do a comparative evaluation and analysis under both regimes and then choose the most beneficial one, as it may vary from person to person. Remember, the choice between the old and new tax regime should be based on your individual financial situation and potential deductions. Stay informed and make the best choice for you.